In this video, I'll analyze the Q1 FY26 result and Concall of RBZ Jewelers. So let's start with the company overview. So RBZ is a Ahmedabad-based jewelry company. RBZ has two segments. One is the B2C segment, one is the B2B segment. In the B2B segment, they have two businesses. One is the wholesale business and one is the job work business, means the advanced gold business. Okay. In terms of the volume, retail business contributes around 30% to their whole volume. Wholesale business contributes around 20% to their whole volume, and the job work contributes around 50%. Okay. In terms of the specialization, RBZ is specialized in the antique wedding jewelry. So that is the company overview. So let's discuss the result of Q1 FY26. So in terms of the revenue, in this quarter their revenue degrew by 8% year on year. I mean, the management is saying that that degrowth happened because of the early Akshaya Tritiya. Like in the last year, Akshaya Tritiya was in the month of May, and in this quarter the Akshaya Tritiya, in this year Akshaya Tritiya was in the month of April. So the whole order book shifted to the March month. So that is why the management is saying that is why the revenue degrew year on year. But if we look at their peers like Sky Gold, like Ashapuri, Sky Gold grew at a rate of 50%, Ashapuri grew at a rate of 20%. Even if we look at the like to like peer like Khajansi also grew at a rate of 6% year on year. So for this company also the Akshaya Tritiya was early. So I do not get the point. Yeah, there can be this can be a reason, obviously, but the main thing is the incremental demand was not there with the RBZ. So that is the main point, because as I said, for Sky Gold, for Ashapuri, for Khajansi, for them also the Akshaya Tritiya was early in this quarter. So that is the point I would like to say. In terms of the segment wise growth, their retail segment was flat year on year. Wholesale segment degrew by 20% year on year, and the job work grew by 8% year on year. So if we look at the segment wise revenue growth also, retail was flat. If we look at the other retail companies like PN Gadgil, like Kulland, they have been able to grow at a rate of 30-40%. So in terms of the retail also, the retail growth has been flat year on year. So I do not get the point. In terms of the wholesale business also, wholesale business degrew by 20% year on year, which is a very bad kind of a thing. Because if we look at Sky Gold, if we look at Ashapuri, they grew at a rate of 50-20%. So that is the point I would like to say. If we look at the RBZ's last few quarters before this Q1 FY26, they were growing at a rate of 50-60%. So this quarter's revenue growth was a little bit disappointing. I mean, very disappointing if we compare it to past few quarters. So that is the point. In terms of the guidance, the management is guiding us for a 700 crore revenue in the year of FY26, which is around 30% growth over FY25. So the guidance, I would say that is on par, but this quarter was really bad. So that is the point with the RBZ's revenue. In terms of the CAPEX also, if we look at their manufacturing unit, they have a capacity of 2 ton per year. Okay, and if we look at their current run rate, they are going at a run rate of 900 to 1000 kg per year. Okay, so they have a fairly good uh, utilization left. I mean, the capacity utilization left. I mean, they are running at a 50% utilization. So that is what the management is saying, that for now, for next 2 to 3 years, they would not need any kind of a capex in terms of the manufacturing unit. If I am not very wrong, they had some kind of a capex plan in terms of the manufacturing, but now they are not interested to invest in that manufacturing unit. But in the future, if the volume picks up, then obviously they will do the capex. But for now, they are not seeing the demand, because the management is also saying that for the whole year they are expecting a flat volume over FY25, which is not a good thing, obviously. So that is the point with the capex. Okay. In terms of the retail segment also, as of now they have one showroom in Ahmedabad, and they are going to open two new showroom by Q1 FY27, and after that they will open another two new showroom in the FY of 28 or FY29. So that is the point with the retail segment. And if we look at the management's commentary, they are saying that they are going to transform this business from a B2B company to B2C company in the future. Because if we look at their volume, in FY25, the volume from the retail was around 30%. Okay, but in the future they are going to increase that volume contribution towards like 50% from the retail segment. Okay, why we should judge this business by volume, not revenue? Because if we look at the revenue, then the job work in terms of the job work, all the company calculate, or all the company recognize just the making charge of the job work. Okay, so in terms of the retail segment or in terms of the wholesale business, they calculate the whole jewelry, they calculate the value of whole jewelry. But in the job work, in the business of job work, they only calculate the making charge. Okay, so that is why we should not look at this business or judge this business by the revenue. So that is why we have to look at the volume. So retail as of now contributes around 30% to their whole volume, and going forward, over next 2 years, retail will contribute around 50% to their whole volume. So that is the point, and that is why the management is saying that over next 2 to 3 years, they are going to be a B2C company than a B2B company. So that is the point. And another thing with this strategy is the margin, because in the B2C segment, in the B2C business, we all know that obviously the margin is higher in the B2C business. So that is why I think in the long run, in the next 2 to 3 years, their margin is going to expand. So that is the point. So in terms of the EBITDA margin in this quarter, EBITDA margin was flat year on year, but quarter on quarter EBITDA margin increased by 600 bps, which is a very good kind of a increase. Okay, so that is the point. But year on year EBITDA margin was flat. So but I think over next 2 to 3 year EBITDA margin may increase further. So that is the point. In terms of the PAT was little bit low, mainly because of the depreciation cost. In this quarter, their PAT degrew by 21%, which is like they did not get the operating leverage or nothing. Obviously, the sales was low compared to the last year's Q1, but PAT was PAT degrew by 20%, more than 20% in this quarter, whereas the revenue degrew by 8%. So obviously there was a operating deleverage. If we look at the margin, PAT margin degrew by 150 bps year on year. So that is what I am trying to say. If I talk about my thinking about this company, like RBZ till the last quarter was doing really good. They were growing at a rate of 50-60%, but this quarter has been very disappointing. Like degrew in the revenue was not expected. Obviously, if we look at the retail sales was flat year on year. If we look at their wholesale business, their B2B segment, the revenue degrew at that business also. So that is what I am trying to say, that even if the company is trading at a 15x PE, I would like to invest in those kind of a company who has some kind of a growth, okay, like 20, 25, 30% minimum growth I would like to see in a company. So whatever PE it can trade, I am not interested in that. So let's see what happens in the next quarter and going forward in Q3, Q4. So that is the point I would like to say. But obviously this quarter was really bad in terms of the result. Okay, so that is the point with RBZ. So that's it for the video. Thanks for watching.